as a type of written order or notice meant for international trade. Bills of exchange can be defined as a type of written order or notice meant for international trade that binds one party to pay a definite amount of money to another party or on a demand or at pre-decided date. So sometimes you may be having a trade between two persons or one or two persons. So at that time, you may not be able to pay in cash. So at that time, the two parties will be entering into an agreement that they will be paying the amount in the future date. So that we call it as bills of exchange. So coming to the bills of exchange, mostly it is of international, is used in international trade to help importers and exporters fulfill these transactions. So a bill of exchange is different from a contract, but can be used by the involved parties to specify the terms and conditions. So first, let me have an history upon these bills of exchange.
Ma'am,
As
your
a
voice
part,
is not clear, ma'am.
okay. Oh, is it clear? Is it clear?
Yes, ma'am.
Yes, ma'am.
Okay. So, as per history, bills of exchange were means of settling accounts in international trade. So, it was used as early as 8th century by the Arab merchants. So, by the 13th century, it has attained wide use in its present form amongst the Lombard in northern Italy. Since the merchants or buyers had their assets dispersed in various banks in many trading cities, it was not possible to get immediate payment by the shipper or seller by a bank. So the shipper would present a bill of exchange to the banker who would purchase it at a discounted price. Since payment was due in the future, so sometimes they will be purchasing at a discounted price. That means if you want amount immediately, so no one will be paying this amount. So these persons will be approaching the bankers at to sale of their bill of exchange, so that these bankers will be purchasing that bill of exchange at a discounted price. So the buying merchant's account would be debited at the due date as per the date mentioned in the bill of exchange. So bills could also be drawn on the bank's direct. Okay. Once the seller received his payment, the bill of exchange continued to function as a credit instrument until it reached its maturity. So now let me give you a definition of this bills of exchange. So according to the Negotiable Instrument Act 1881, a bill of exchange is defined as an instrument in writing containing an unconditional order signed by the maker directing a certain person to pay a certain amount of money only to or to the order of a certain person or to the bearer of the instrument. So according to this Negotiable Instrument Act, Act of 1881, so this bill of exchange defined as an instrument in writing. So always the bill of exchange is instrument in writing. That means it has an importance as a bill in writing. Okay. So if you take this definition, there are certain features which we can get from this definition. So first thing is, it is important to have a bill in writing. Always the bill should be in writing. Suppose if there is any default by the other person, then the other person may go to the court of law. So always the bill should be in writing. Okay. And the other thing is, it must contain a confirmed order to make a payment and not just the request. So the bill of exchange is just it is an order, but not it is not a request. Okay, it is not another person to request to pay amount. So always it is the order wherein the other person have to pay to that person. Okay, so the order should not have any condition. So it is unconditional, should not have any condition. And the bill of exchange amount should be definite. So whatever amount the person is going to pay or a person is going to receive should be a definite amount. And the amount should be paid on a fixed date. So a date is fixed to the other person to pay the amount. So there should be a fixed date, and we should not give it casual that it may be paid after 3 months or something. The amount, the date should be fixed, and the bill must be signed both by the drawee and the drawee. Should be signed by both the drawee and the drawer. And the amount paid on the bill should be paid on demand. Whatever amount the person is going to pay, it should be paid on a demand on the expiry of a fixed time. Always you will be giving a fixed time. So at that time, you have to pay the amount. So the amount is paid to the beneficiary of the bill, specific person or against a definite order. Sometimes uh, you may be mentioning the person to whom you have to pay. So you can give the beneficiary name to whom you have to pay. So coming to the definition, through this definition, you may identify all these features. I once again repeat this definition. So according to the Negotiable Instruments Act 1881, a bill of exchange is defined as an instrument in writing containing an unconditional order signed by the maker directing a certain person a certain person to pay a certain amount of money only to or to the order of a certain person or to the bearer of the instrument. Now, if you take the parties to the bill of exchange, usually there are three parties to the bill of exchange. One is the drawer, the other one is the drawee, and the third one is the pay. Now let me discuss about what is the drawer, or what is a who is a drawer, who is a drawee, and who is a pay. Uh, the first thing, first person is the drawer. So the drawer is the maker of a bill of exchange. So he is the person who makes the bill. So the bill is signed by the drawer. A creditor who is entitled to receive payment from the debtor can draw a bill of exchange. Suppose this drawer is a seller, and this seller might have sold some goods to the other person B, and the person B may not be able to pay the amount at present, may not be able to pay the cash at present. So at this stage, this drawer will be writing a bill. Understand? So he makes a bill. He makes a bill to the drawee to pay the amount on certain day. So a drawer is the maker of the bill. So the bill is signed by the drawer. So he is called the creditor. That means he is a person who has to receive the payment from the debtor. So he can draw a bill of exchange. So now uh, let me explain who is a drawee. Okay, drawee is the person upon whom the bill is drawn. Bill of exchange is drawn. Okay. Drawee is the debtor who has to pay the money to the drawee. So this drawee is the person upon which the bill is drawn. That means the drawer will be making the bill and he will be sending for the acceptance of this drawee, sending this bill to the acceptance of this drawee. Okay, drawee is the debtor who has to pay the money to the drawer. So he is also known as the acceptor. So he is the person who has to accept. Now, let me explain who is a payee. So payee is a person to whom payment has to be made. Payee is a person to whom the payment has to be made. The payee may be the drawer himself or a third party. So sometimes you may be giving a person's another third person's name to pay. Sometimes you may be writing your own name. For example, I may be the drawer. So I may be I may be making a bill of exchange, but at the time of the receiving of this amount, I may not be receiving. Sometimes I may be giving a third person's name to pay. So this drawee may not be paying the amount to me. So whoever name I have mentioned on the bill, the drawee has to pay the amount. Okay. So that person we call him as a drawee. Pay. Okay. Now let us see the advantages of this bills of exchange. So the need and importance of bills of exchange are most evident when there is export involved. Sometimes if you are exporting goods to the other person, then it may be helpful for you to go for a bill of exchange. But there are some risks related to exports of products which domestic businesses are not aware of. The bills of exchange can help in countering some of those risks related to the export of goods. Now, let me have some of these advantages of these bills of exchange. So, the constant fluctuations in the rate of exchange can adversely affect long-term trading arrangements. So, if you take this rate of exchange, the rate of exchange may be changing from time to time. So, when the exchange rates are changing from time to time, you may be having a long-term impact on paying the bills. In such a scenario, the fixed term of payment which is laid in a bill of exchange can give assurance to the exporters of receiving with fixed price. So in the bill, you may be giving a certain amount. So if you write a bill, so you are sure to pay that amount, irrespective of this the fluctuations in the exchange. Okay. And the other advantage of this bills of exchange is the exporter is also getting protection with the bill of exchange. Okay. The exporter can draw up a bill of exchange with their bank and submit it to the importer's bank. So this way, exporters gain an agreement in which they do not need to chase the importer for payment in the event of a company fails to honor the agreement. Understood? Here, the exporter can draw up a bill of exchange with their bank and submit to the importer's bank. So you may not be running after these importers. You may be giving this to the importer's bank, submitting it to the importer's bank, and the importer's bank will be taking up this charge. The other advantage is adequate time for payment. Primarily, importers buying goods and services get sufficient time limit to pay the purchase by negotiating in bills of exchange. It is an advantage to the importer to arrange payment for the bill of exchange. So you may be getting a sufficient time. Okay. And the other thing is legal action. Legal action serves as a basis for the exporter to challenge the bill of exchange. basis for taking legal action in case of buyer fails to pay the due. Sometimes some of the imported fail to pay the amount. So in that case, this bills of exchange will be helpful in going to take a legal action. And the other advantage is it helps to enhance the per capita income of the country. And the government is benefited from these foreign trades. And the other advantage is terms and conditions. The bill of exchange can only be signed if the terms and conditions are read and accepted by the actor. So when a drawer makes the bill, then he will be giving or he will be sending this bill to the drawee to accept. So this drawee will be taking into consideration all the terms and conditions mentioned in that bill by the drawee. When he is satisfied, then he will be signing the bill. Okay. So this drawee will be reading and accepting the bill. And the other thing is it have an easy transfer. The bill of exchange are transferable. That means the bill can be transferred to any third party, including endorsing and the liabilities related to it. Sometimes you can transfer your bill to the other person, or you can endorse it to the another person to get the amount. And other advantage is mutual accommodation. The bills of exchange are drawn to meet the financial needs of others. So this bill is issued to accommodate the other party with the common decision. Sometimes it serves as a legal document. So it is a legal document, and if the drawee fails to make the payment, it will be easier for the drawer to recover the amount legally. And the other thing is discounting facility. So in cases where the drawer is in immediate need of the money, he may not be able to, he may not wait for the money, wait for the drawer to pay the amount. Sometimes he can take this bill, submit into the bank, convert this into cash. Sometimes you have to bear some nominal charges. So banks will be paying the amount on discounting the bill. And the other one is you can endorse. That is, endorsement is possible in bills of exchange. So this bill of exchange can be exchanged from one individual to the another for the adjustment of the debt. So some of the persons, in order to adjust their own debts, they may be transferring this bill of exchange to the other person. Okay. Now, let us see the different types of bills of exchange. Hope you understood about the advantages of the bills of exchange. Now, let us deal with the types of the bills of exchange. The first thing is a documentary bill. One type of bill is the documentary bill. So in this, the bill of exchange is supported by the relevant documents that confirm the genuineness of sale or transaction that took place between the seller and the buyer. So it shows the genuineness. What are the goods you have sold to the person, and with how much amount you have sent, and also what are the quantity? Is the quantity it has they have purchased. Okay. So the bill of exchange is supported by the relevant documents that conform to the genuineness of the sale or transactions that took place between the seller and the buyer. And the other one is the demand bill. So this demand bill is payable on demand. So this bill is payable when it is demanded. The bill does not have a fixed date of payment. Therefore, the bill has to be cleared whenever present. So in this may not be mentioning any date, but whenever it is presented, you have to pay the amount. And the other type of bill is the usance bill. It is a time-bound bill, which means the payment has to be made within the given time period and time. That means you have to pay. Here the time is given. Here you have to pay within that time. So we call this as time-bounded bill. And the other one is inland bill. So an inland bill is payable only in one country and not in any other foreign country. So this bill is opposite to the foreign bill. Okay. Coming to the foreign bill, a bill that can be paid outside the country. Suppose you are residing in India. Now you are residing in India. So you can pay the bill outside India. So this we call it as or termed as the foreign bill. The two examples of this foreign bills are the export bill and the import bill. And the other type is the clean bill. So this bill does not have any proof of a document. So the interest is comparatively higher than the other. Here you may not be having any proof of document, but you need to pay higher amount. Another one is the accommodation bill. So a bill that is sponsored, drawn, accepted without any condition is known as accommodation. Bill is sponsored, drawn, accepted without any condition. So there is no condition. So that type of bill is called as accommodation. And the other one is a trade bill.
Ma'am, your
So
voice
this
is
type
not
of
clear,
bill
ma'am.
is specially related only to trade. That we'll be learning in the next unit. Now, is it clear for you?
Ma'am. Yes, ma'am.
From my side, there is no disturbance.
Distance in your headphone, ma'am, I guess.
Headphones. Can you hear me?
Yes, ma'am.
Okay. Next, supply bill. So the bill that is drawn by the supplier or the contractor from the government department. Sometimes he will be supplying goods to the other person, the government department. So supplier or contractor from the government department, we call it as a supply bill. Okay. So these are the different types of bills. Now, let us see some important terms in these bills of exchange. The first thing is term of a bill or period of bill. So, if you take this term of a bill or a period of a bill, it is the time period between the date on which the bill is drawn. Understood? It is the time period between the date on which the bill is drawn and the date on which it is paid. Bill is drawn on a certain day and the amount has to be paid on a certain day. That we call it as term of the bill. And let us see another thing, that is the due date. So it is the date on which the payment of the bill is.
यह हेडफोन की चले गई हेडफोन खराब हो गया
It is the date on which the payment of the bill is due. And the other term is days of grace. Sometimes you have to pay the amount on a certain due date, but here you will be giving 3 days of grace, extra day. There are 3 extra days added to the period of bill. Suppose if you are going to pay the bill at the end of 31st May. So after those 3 extra days will be given for you, and those 3 days will be called as the grace days or the grace period. And the other one is the date of maturity. The adding 3 days of bill. Suppose I have the due date is 31st May, and I have given 3 extra days of grace. So after 3 days, here you have to pay the amount, and the date after these 3 days, after adding these 3 days, we call it as date of maturity, wherein you have to pay the amount on that date. So is it clear? Is it clear for you?
Yes.
And now let me explain about the discounting of a bill. The term discounting of a bill.
नहीं बोली जो माँ
It means enhancement of bill before the date of its
शादी
maturity.
के बोले वहाँ पर बैठ के बात कर लेते क्या बोले
The bank deducts its charges from the bill. Suppose if you want the amount before the due date, so for that you will be going for a bank and you will be giving this bill in exchange of cash. So for receiving that bill, for paying the amount before the due date, the bank will be discounting. So some discounting charges will be applied. Now let us see endorsement of a bill. So endorsement means the transfer of bill or promissory note to another person. So sometimes you may be transferring the amount to the another person. So that we call it as endorsement of the bill. So it is transferred an account of some settlement of debts or dues. Sometimes you have to pay some amount as debt to another person. So instead of paying the cash to the another person, you will be endorsing this bill to the person. So that we call it as endorsement of the bill. Next, bill sent for collection. So when a bill is sent to bank for collection with instrument, that it will be retained till the maturity date. So you'll be sending this bill to the other person, to the bank, and that bill will be retained, or that instrument will be retained till the maturity date. And bill will be realized on its due date. It is known as bill sent for collection. Okay. And let us see another term, that is a dishonor of bill. When payment is made by the acceptor of the bill on its due date, when the person is not made by the, when the payment is not made by the acceptor of the bill on its due date, then we call it as dishonor of the bill. Sometimes some of the persons may not be paying the amount on the due date. So they fail to pay the amount on the due date. And we call that as dishonor of bill. And the other one is noting of a bill. On dishonor of a bill, when this fact is brought to the notice of the notary public. Sometimes if your bill is dishonored, and this dishonored bill is brought to the notice of the notary, then we call it as noting of a bill. And the other one is noting charges. So it is the fee paid to the notary public for noting of the dishonor of the bill. So when you have sent this to the, when you have sent or notice, when you send a notice to this notary public, then you have to pay some amount. So that fee which you are going to pay is called as noting charges. Let me take to another term, that is retiring of a bill. So when a drawee pays the bill before its due date, it is termed as the retirement of the. So some of the drawees may be failing to pay the amount on the due date, that we call it as dishonor of the bill, and some of the drawees may be paying the amount before the due date, that we call it as retirement of the bill. So it happens with the mutual understanding of the drawer and the drawee. So to encourage retiring of the bill, that means before the payment of the before the maturity, payment before the maturity, the holder allows some discount called a rebate. So if you are paying before the date, so in order to encourage those persons to pay before the maturity date, so to encourage these type of persons, sometimes they will be allowing some discount. So that we call it as rebate on the bill. Okay. And the other one is the renewal of the bill. When the holder of a bill is not in a position to meet the bill on the due date. Actually, you need to meet the bill on the due date, but you are not able to meet the bill. You are not able to pay on the due date. So drawee approaches the drawer with a request to extension of time for payment. So if the drawer accepts it, sometimes they may be extending the amount. Sorry, date. So that we call it as renewal of the bill. Understood? Suppose if the drawee is not able to pay, or he is not in a position to pay the amount on the due date, this drawee will be approaching the drawer and request the drawer to extend the due date. So this extension of time, we call it as a renewal of the bill. Okay. So if drawer agrees, the old bill is cancelled and a fresh bill is prepared in new terms of payment and is drawn and duly accepted and delivered. So that we call it as renewal of the bill. And let me explain some of the other terms which is related to the due date of a bill. That is when the period of bill is given in months. When the period of bill is given in months. So in this case, the maturity date is calculated according to calendar months. In this case, the maturity date is calculated according to the calendar month. So ignoring the number of days in a month. Sometimes you will be, you may not be considering anything, ignoring the days in a month. That means 3 days of grace period are added. For example, if a bill dated 4th May 2020 is payable 3 months after date. So it is in the middle of the month, not at the beginning, that is May 1st or June 1st or anything. Suppose a bill is drawn on a bill at 4th May 2001. It is payable after 3 months. So then the maturity date will be 4th August 2020 plus 3 days of grace days. That means you have to pay the amount that is on 7th August 2020. Understood? Suppose you have drawn the bill on 4th May 2020 and it is payable after 3 months. Now calculate from May 4th. May 4th to June 4th, June 4th. By the end of the 4th, that is at 4th August, 3 months will be completed. Again, 3 days of grace days will be added to this 4th. That means 4 plus 3, 7. On 7th August, you have to pay the amount. Understood? And the other thing is when the period of bill is given in days. Sometimes you may be giving the period of bill in months, and the other thing is when the period of bill is given in days. So the maturity days date will be calculated in days. Sometimes 45 days or 65 days, like that you will be preparing the bill according to the days, not in months. So the maturity date will be calculated in days. So this excludes the date of transaction, but includes the date of payment. So suppose if I'm doing the transaction today, so I will be excluding this and you will be including the date of payment. Again, here also 3 days of grace days will be added to these days. For example, if a bill dated 5th June 2020 is payable after 65 days. Suppose if bill dated 5th June 2020 is payable after 65 days. Here I am not mentioning any months, but I am mentioning days. Then the maturity date will be 25 days of June plus 31 days of July plus 9 days of August plus 3 days of grace. Understood? So if you take the bill, here the bill dated is 5th June. On 5th June, you have billed the exchange. From 5th to 30th June, how many days? 25 days plus July, 31 days plus 25 plus 31. How many days? 56.
56.
56 plus 9 days. 65 days. Isn't it? 65 plus 3 days of grace. That is, it comes to 12th August 2020. Understood? Now, sometimes when the maturity days falls on national holiday, you need to pay the amount. Sometimes the date may fall on the national day. Then in that case, what you have to do? If the due date of the bill is on the national day, then the maturity day of the bill shall be the preceding business day. Understood? Suppose the bill, the amount of bill you have to pay comes on 15th August. 15th August is a national holiday. So you have to pay the amount the preceding business day. Understood? Preceding business day means 14th August. Suppose if the bill falls on 26th January, that is on the Republic Day, then its due date will be on 25th January. Understood? Okay. And sometimes when the bill, when the maturity date has been declared as emergency holiday, it may not fall on the national holiday, but the date of the billing day or the emergency, the due date may fall on the emergency day. All of a sudden, the government have declared emergency holiday. Then the due date of the bill shall be after 1 day from the date of maturity. For example, on 26th July, you have to pay the bill. So 26th July is the due date. But on that day, the government has declared an emergency holiday. So in that case, you have to pay the amount on 26th July. You got it? Suppose you have to pay the amount on 25th July. So 25th July is a due date. But all of a sudden, the government has declared an emergency holiday. So in that case, you have to pay the next day. That is on the 26th July. Understood? So these are the different points you have to consider while preparing the accounting for these trade bills. You have to consider at which time you have to pay, what are the grace days, if there is a national holiday, what is the due date. If it is a national holiday, before day you have to pay the amount. Understood? Suppose if an emergency holiday is declared, the next day you have to pay the amount. Like that, you have to consider all these points while preparing the bill and payment of the bill. Okay. So with this, I shall close today's class. Tomorrow we
Ma'am,
shall be able
can
to.
you have the PPT of this topic?
Yes, I had the PPT, but I'm unable to share my PPT. All of a sudden, in my laptop, the Zoom app have not worked, so I have connected to the mobile phone. Actually, I have prepared
Okay,
this
ma'am,
PPT for you.
can you give that tomorrow?
Okay, okay,
Okay, ma'am. Thank you, ma'am.
okay.